Hello, this is Justin Martin. Thank you for joining me here to talk about policy structure. I'm a wealth strategist with Paradigm Life, and we'll be spending a couple minutes here in this tutorial talking about one of the aspects of the perpetual wealth strategy. Now, as we've discussed in other videos, this type of a system is known by a lot of different names: the infinite banking concept, income for life, the perpetual wealth strategy. But it's all the same concept, and that is the building of a cash-rich whole life insurance policy and then utilizing it with your overall financial objectives and financial goals. Now, when putting this type of a system together, this wealth maximization account, it is absolutely critical that the structure of the policy is correct. Okay. Now, as a reminder, we are using a traditional whole life insurance policy. But instead of focusing so much on the death benefit of the policy, we're transitioning to focus more on what is called the cash value of the policy itself. Now, it's this cash value, as we've discussed in other videos, that gives us all of these different living benefits associated with the policy. Okay, so as a quick reminder, when we talk about cash value, this is where we're getting all of the guaranteed growth associated with that savings account. This is where we're getting the dividends. And if structured correctly and utilized correctly, all of that can be utilized in a tax-free way. Okay, so this is what we're creating here. Now, when we put the policy together, this is what it looks like. The premium payments come into this policy. Now, when you go out to an insurance company and say, hey, insurance company, I would like a life insurance policy, the insurance company comes back and says, okay, if you want that much death benefit, if you want this insurance policy, then you have a required premium payment that you have to pay every month or every year. However, you just decide to structure those premium payments. Well, this required premium payment, this is what we call the base premium payment. Okay, the base premium payment is a fixed or required or static payment that you have to continually make throughout the life of the policy. Now, this base premium payment, because, well, this is where your death benefit is located. Okay, you're purchasing this death benefit. You're putting together this death benefit. Now, because this is where your death benefit is located, this is where all of the cost of insurance is going to be located. Okay, this is where your fees are. Now, the cost of insurance associated with a whole life insurance policy is front loaded into the first couple or few years of that insurance product. Now, the cost of insurance is going to be different for every whole life insurance policy. It depends on your age, your health, the size of the policy. There's different factors that go into this overall cost of insurance. So make sure that you give me a call so we can look at what that actual cost of insurance is. One of the reasons why I want to point out that cost of insurance is because when you're looking through all of the contracts associated with your insurance policy, you're not going to find this actual breakdown of how much does this policy cost me. It's not required to disclose it by the insurance company, so you're not going to find it in there. However, give me a call. Let's look at your policy together. Let's look at a new policy together. Let's figure out what that cost is. Or if you've got a policy that you're currently looking at and just want some help breaking that down, let me know. Okay? Now, once that cost of insurance is satisfied in the first couple of years, this base premium is still required. However, the money going into that base premium payment, that starts to show up in the cash value. Okay? So now we're really starting to build our objective here, and that is to get the cash value growing. Now, this kind of a policy here, where it's a base premium payment only policy, it's a decent policy, but it can be pretty rigid. All right, and you're not going to see a lot of growth up front because of that heavy cost of insurance. You're still going to build cash value eventually, though, so it's not the end of the world to have a policy like this. However, we want to be a little bit more efficient with our premium payment. So we put an add-on onto the policy. Now, every insurance policy out there has this kind of a la carte menu of different add-ons that you can put onto your policy. Those add-ons are what are called riders, okay? There's a variety of different riders that you can put on your policy. The rider that we're talking about here today is the Paid Up Additions rider. Okay, and you'll see this also be abbreviated as PUAs. Okay. Now the Paid Up Additions rider, the PUAs, in essence what you're saying to the insurance company is, insurance company, I want to put more premium payment into the policy than is required. If you require $1, maybe I want to put $3 in. Okay? It's just opening the door for you to save more money into the policy, because ultimately what you're doing is you're building more cash value. Okay? As you put more paid up additions in, you're building even more cash value in the policy. You see that money landing in there. Now, by default, you're also having a growing death benefit. Okay? So, even though we're trying to build this cash-rich life insurance policy, it's still insurance, so there will still be death benefit associated with the policy. Now, our objective here is to get this cash value growing as quickly as we can. So we're trying to get as much money into the paid-up additions as we can, while trying to minimize the base premium payment as much as we can to get that cost of insurance down. Okay? That's the objective. Now, this is where the IRS steps into all of this. And the IRS says, hey, we're so glad that you're putting money into your insurance policy. In fact, we're trying to incentivize you to put money into the policy by making this a tax advantage type of a policy. But based upon the tax code 7702, which they refer to as the MEC limit, Modified Endowment Contract Limit, based upon this MEC limit, there has to be a certain balance at all time between your cash value and your death benefit. So the IRS has an algorithm that they use in order to calculate exactly what that balance is going to be between the cash value and death benefit. And it's going to be different for every single policy. Again, it depends on your age, your health, the size of the policy, etc. But to put it in very layman terms here, we could say that for the most part, what we're trying to do is get it so, let me get a different color here, let's say, 30% of the money that you put into the policy is going to go to the base premium payment, and the other 70% of the money can go to the paid up additions. Okay, so again, 1/3 of that money going to the base premium payment, the other 2/3 more or less going to the paid up additions. We're trying to get as close as we can to this 30-70 split. It's not going to be that same for every policy. That's more of the ideal. Okay, that's what we're trying to do here. Or if we just put some quick numbers with it, we could say, you know, if you put $300 into the base premium payment, you could put another $700 into the paid up additions for a grand total of $1,000. Okay, and we could just put zeros on all of this, or take zeros off. Okay, so if you put $3,000 into the base premium payment, you could put another $7,000 into the paid up additions for a total of $10,000. Okay, it's a scalable amount. All right. So again, structure is important here. Now let me add one level to this. Let's say here, let me just diagram something here really quickly. Let's go. Okay. We're going to say this represents the base premium payment, this represents the paid up additions, and the full amount is your total premium payments going in. Okay, I just want to clarify how this is working. Now, you're coming along, and this is going to represent the first year of your policy, the second, the third, the fourth year, and on of your policy. That first year comes along and the insurance company says, hey, you've got a required premium payment that you have to put into the policy. Now let's use those round numbers again. Let's say that dollar amount is $300, okay? So you're required to put the $300 into the policy. I don't know, that could be $300 a month, $300 a year, whatever it may be. Okay? Well then, because you've elected to have the paid up additions on there, you have the flexibility to contribute money into the paid up additions. Okay? This top line up here is your MEC limit. This is the IRS's limit on your policy. As long as we stay underneath this MEC limit, your policy can be tax-free. If you cross over that limit, it's okay. You still have the insurance policy, but now your policy has become what's called a MEC contract, an MEC contract, which means your policy is now subject to paying taxes on the growth of that policy. So our objective here is to stay underneath that MEC limit. Second year comes along, okay? You're required to put that money into the policy. Oh, let me get these other numbers on here. $700, okay? That second year of the policy comes along. You're putting that $300 in. You can put another $700 in. However, let's say, for whatever reason, you're not putting in $700 per month or $700 per year. Well, the insurance company allows you to ebb and flow with your paid up additions, okay? So some years you're putting the full amount in, other years you're not, and you have this flexibility in the policy in order to determine how much you want to be putting away into the cash value. Now, the way that these paid up additions work and the flexibility associated with them is going to vary a little bit from one insurance company to the next. So make sure we discuss and that you fully understand what that flexibility means. However, bottom line here is the base premium payment is the required amount you're putting in. The paid up additions is going to be a more flexible amount, but the objective here is to get as close to this MEC limit as we can every year, because the more money you're putting into the paid up additions, the quicker you're building that cash value, the quicker you're going to start to see the living benefits associated with the perpetual wealth strategy. Okay? So as we look at your specific policy, this is more or less how we're going to be breaking down your policy. So this is the conceptual side. Now let's meet together to look at an actual tailored plan around you. All right? So thank you again for joining me here to talk about policy structure.